me ask you something most investors do not think about. What happens if your sponsor disappears? Not figuratively, literally. They step away, they burn out, they get sick, or something goes wrong operationally, they just stop communicating whatsoever. Who is running your deal in that scenario? Because when you invest in a syndication, you're not just investing in real estate and the deal itself. You are investing in the operator, in the people behind the deal. And that creates what is called key man or key woman risk. Now, most offering memorandums will mention it, but very few investors actually evaluate it. So here's the reality based on my experience. In many deals, there is one or two individuals who drive everything. They source the deal, they raise the capital, they oversee the execution. So if that person is no longer involved, the business plan can actually break. And when the business plan breaks, your returns naturally follow. Now, in a well structured deal, there are safeguards for that. So you may have co sponsors, you may have an experienced property manager and extended management team, you may have defined roles across the team, but not all teams are built the same. Some are deep with the safeguards I mentioned above, and some are very thin. And from the outside, it is not always that obvious. Here are a few things I look for. First, depth of the team. If one person disappears, who steps in? And do they have the experience necessary to actually execute? Second, role clarity. Who is responsible for what? Acquisitions is not asset management. Asset management is not operations. You want to see clear accountability across functions. Third, continuity planning. Has the sponsor thought through this scenario and what happens next? Is there a backup plan or is everything dependent on one individual? And fourth, alignment and control. Who has decision making authority if something changes? Because in some structures, even if there is a team, control still sits with one person. Now, this is not about assuming the worst at all, but it is about understanding how the deal performs if something goes wrong. Because that is also how lenders think, and that is how I was trained to look at risk, not based on the best case scenario, but based on what happens when things do not go according to plan. So, the next time you review a deal, ask this question. If the sponsor is no longer there, what happens to my investment? Because the strength of a deal is not just the upside, it is in the ability to survive disruption. Protecting your capital starts with understanding who is really behind the deal and what happens if they're not.